Today we are going to be talking about NAV erosion and how to defeat it. The scary NAV. If you are on forums or on Reddit, you're pretty familiar with the term NAV erosion. It's a very common argument against covered call ETFs like YieldMax and others distributing high income. The share price erodes over time, but there is ways to counteract that, and that's what we're going to be talking about today. So the big example that I see on Reddit is ULTI, YieldMax's Ultra Option Income Strategy ETF. And if you look at this chart, they're right. Look at this cratering chart, just going straight down. And the fund was started in March of 2024 and has just seen some significant drop in the share price. And just about middle of 2025, we're seeing some stability. And I'm a big fan of Ulti and hoping that this new strategy, perspectives change on Ulti, is going to help with that NAV within the fund itself. But, anyways, what is NAV? NAV is the net asset value or the total amount that the fund is worth divided by the shares. And that's how the share price is determined. A NAV erosion, decay, whatever you want to call it, is when the fund pays out a distribution and then it has less cash or assets left. So the NAV goes down, that share price goes down to compensate after that distribution is sent out to investors. And this is specifically common in funds that focus on generating high income because they distribute high yields. They distribute high income out to those investors. So this happens on the ex-dividend date adjustment. Pretty easy to find the ex-dividend dates before distributions are paid out. But specifically on this day, that um, amount is taken out from the net asset value, thus eroding it away, if you will. So, for example, if the share price is $10 and the fund is going to pay out $1 on that ex-dividend date, the price will fall to $9 on that date. Now, is it a loss? Technically, no, because the investor is getting the distribution, so the value is essentially the same. If you add up 9 plus 1, you still have 10. But this is very common with YieldMax and other high income ETFs is you see that degrade on the ex dividend day. Now, how do you defeat NAV erosion? Number one is you need to reinvest in back into the fund. And if you are listening to any of the fund managers or people representing these companies that execute the high income ETF strategies, they say that a part of the performance of the fund should be reinvestment back into it. Now, DRIP is 100% reinvesting right back into the ETF itself. It's pretty easy to set up on a brokerage account. Um, and that's just automatically rolling it back into the ETF itself with the compounding growth versus reinvesting a portion of the distributions. And this would be you manually allocating a certain percentage to invest back into the fund. Right now, with this kind of bull market we're in, stocks are going straight up every single day. I'm seeing green. I'm only allocating about 10% of that distribution back into the funds. Now, number two, you buy the dip. You have cash on the sidelines and you're ready to deploy that cash when there's a dip. I mean, if you look at this chart on XDTE by Roundhill, it's the S&P Covered Call Strategy Fund. Where that white arrow is, that's where you invest. After a big drop and the NAV has declined, the net assets have gone down, that's when you buy in because you have a little recovery here to the right. After the tariff drama, the stock market started to go back up, but it did not fully recover to where it was before. So this buying the dip is helpful, and covered calls can't quite make it all the way back to where they once were because they are um, distributing, you know, monthly, weekly, whatever is their distribution rate. Number 3 is we're pairing it with growth or stable anchors. Now, this is a chart of the S&P 500. The thing just goes up and up and up. So it's not going to help with the NAV of the covered call ETFs themselves, but it's going to help your account overall. I like the S&P 500, broad-based index funds, gold, Bitcoin for growth, and that is hopefully helping your account value stay either the same or going up over time with the covered call strategies as well. Number 4 is just selling any losers, okay? Your maybe individualized stock like Tesla, TSLY, if you're investing in the covered call strategies on Tesla. If the share price of Tesla is going down and the distributions are high, you're gonna have some erosion of the fund, and you're gonna see your account value of that specific ETF go way down. So sell out of any losing positions if you're not satisfied with the distribution and the total return. And just remember that covered call strategies, covered all ETFs are not a free lunch. It's not, you know, 80% yield and no NAV erosion for the end of time. There's a give and take with this strategy, but you should consider the total return. So the share price plus any distributions that you're getting should be calculated into the performance of these funds. And do your own research before you invest. Make sure that you understand NAV erosion before you choose to invest in some of these strategies. Okay. All right, friends. I hope that helped uh, with some of like the NAV erosion questions out there. And have a wonderful day.